coming back a little bit this morning, even as we've gotten into earnings season, and the bank's reaction has not been as positive. But there seems to be a lot of optimism still going into this earnings season.
There is, and I think we are in that camp. We do expect in aggregate earnings to be up double digits this year. And what's important to note is that's happening at a time when we are not necessarily benefiting from any base effects. In other words, last year was also very strong. We saw momentum continuing from Q1 to Q2 to Q3, and we do expect Q4 to moderate a little bit, but you'll end up with double-digit earnings even in 25. So that's a very strong setup, for example, compared to Europe, where earnings have been flat for 3 to 5 years, and there's expected to be some pickup from there, right? So the setup is very good. We do think that tech and the broad TMT space remains central to getting where we want to. To the extent that a space wobbles, we have a hard time seeing the market managing to push through without their leadership.
And when we talk about leadership or not, lack of leadership, your team recently did some work on single stock volatility, the individual moves we see in stocks, which tend to be then magnified even more during earnings season as we're seeing the reaction to earnings. But when we're seeing so many individual sort of idiosyncratic moves, what does an investor kind of do with that?
It's very interesting because one of the interesting things, and we expect that to continue this year, is like you noted that dispersion within single stocks of returns has been extremely high. The corollary to that is the fact that the correlation, whether it is between sectors or for stocks within sectors, or for stocks within S&P itself, is at historic lows. So in principle, this is an extremely good environment for stock picking and hence for active management. But the caveat is that returns still continue to be very concentrated. So if I look at the rolling 12-month returns, even now, or at least only 35% of stocks in S&P have done better than the index returns, right? So returns do get concentrated. If you look at the top 10 contributors to S&P returns last year, not surprisingly, 5 of the big tech 6 stocks are within those. So I think it's a very tricky market where, in principle, it is a stock picker's market, but navigating that is not going to be easy. And to your point, one of the points we noted was the volatility attributed to earnings has increased to the highest levels in a long, long time. So, and that's partly to do with the fact that information dissemination is moving very fast. So people are processing information, reacting, but that doesn't necessarily make an investor's life easier in navigating that. The last point I will make is that even big tech, on which we're very positive, which by the way is close to, call it 35% of the market and accounts for well over a quarter of S&P earnings, the correlation between those 6 stocks itself is hitting multi-year lows, right? So it was either ways to begin with in the 40 to 50% range in the past, call it a few years. Now we're in the 20 to 25% range. So if you can navigate even these 6 stocks, it can turn out to be great. But that's not to suggest that navigating and timing that is an easy task.
No, it doesn't seem like an easy task at all. I mean, and not only is it hard to perhaps look at the market from a macro perspective, sort of that quote unquote top-down perspective, but even applying sort of thematic lenses might be somewhat challenging. The growth versus value debate that has come back, or looking at certain sectors within the market because of that dispersion. Do you not want to buy the whole S&P 500 right now? You want to just go in and look at individual stocks?
Well, to the extent that you're confident in doing that, but it's going to be treacherous and tough. But owning the index is not a bad option at all. And I think, but if you look back, our own view is that, we actually remain positive on fewer sectors, as opposed to buying everything,
Gotcha.
Right? So we continue to like tech broadly, and within that big tech even more. We like financials and we like utilities. But the underlying theme which continues to dominate the market is a broad AI theme. And our core conviction is that it'll sustain this year, even though the level of scrutiny around that has decidedly increased. So we are now in the 4th year of this AI cycle. And as some of these big hyperscalers are increasingly tapping the public and private credit markets. There's an extra pair of eyes in terms of scrutinizing what the underlying fundamentals are, what the balance sheet strength is. And the credit market itself is being very efficient in terms of pricing the risks across. So in other words, if you look at where the credit default swaps or spreads are of an Amazon or a Google, is very different than what it is for Meta, which is in the middle, as opposed to, let's say, an Oracle, which is another spectrum. So I think the market is sorting things out, but the theme is very much in place. AI adoption is expanding. The big hyperscalers are already monetizing AI to a substantial level in their own core businesses, and the use cases is expanding. That said, enterprise usage is still quite low. So I think the whole play now has entered a different phase of applications down the line for a wider adoption. But as we wait for that to unfold, I think tech, especially the big tech, and AI as a theme, is the core of this market.
And it's interesting that you say that, because we were talking during the break about how we came back from our holiday breaks, rested, ready to go, and it has just been headline after headline, Truth Social post after Truth Social post coming from the president that have created some turmoil. Is basically what you're saying, like AI is the more powerful force, and maybe try to disregard some of that headline risk?
Yeah, broadly speaking, I think the lesson from 25 is to ignore the policy-driven sort of chaos. And I think the message is broadly the same. The tricky part is every now and then, some of those policies are indeed translating into something very tangible. So what is the direction of that is important. And of course, this year is the midterm elections, so you can expect more, what should I say, policies more friendly towards sort of that process, but that have different implications. What does it mean for the deficits, which have been actually going in the right direction, but what does it then mean in the credit markets? Right now, the rates market, for example, is very benign. The 10-year is still sitting at 415. We are not in danger zone at all. Equities have done well. But to your point, though, the policy uncertainty is adding fuel to this dispersion we are talking about, where at the index level, things are relatively calm, including with the VIX. But at the single stock level, the volatility is very high. And if you look at each of these pronouncements, whether it is about credit card capping fees, whether it's about the ability of institutional investors to buy into the housing market, whether it's defense companies being able to buy back stocks or pay their in compensation, each of these has caused a lot of volatility in individual stocks for a brief period of time. And the question is, how realistic is it and how likely is it that it translates? So in the case of financial, for example, we remain very optimistic. I think valuations are decent, capital market activity is humming, M&A activity is likely to pick up, the yield curve has already steepened, I think it will remain steep, which is good for the